I think it's a bunch of nonsense that the Western media runs with this, because after 18 months of recording purchases, go back and look at what happened way back when. They never updated their numbers. And so this is a deal, as you mentioned, of complete and total gaslighting, and look what it did to the price. And that's the idiocy of the Western investor, who does things reactionary instead of being proactive, seeing things for what they are, understanding that in the end, the numbers will play out, I think, outperform everybody's expectations. But to your point, Andrew, the gaslighting, the reactionary environment in the West is silly. If you can't see where this is going, and you just react to the news in the West. I mean, it's funny because all of a sudden you get Reuters talking about China stopping buying gold, but they never talk about gold.
At least in my opinion, what will be the final financial crisis is still slated to come this year. I'll show you two triangulating charts that suggest this. Don't prove it, but suggest that we are still on track for a financial crisis by the end of this year, which will lead to the next money printing round. By extension, should lead to stagnant stocks and a rising gold and silver price, very much like the 1970s, which was actually worse than 1930s in terms of stocks relative to gold and silver. Because remember, in the 1930s, the dollar was gold. In the 1970s, it wasn't. We have a huge triangle in gold to stocks ratio that is going to break out in the next few months. And we're going to take a long-term look at the gold stocks ratio and what I call the bikini of doom.
Economics mean that China's paying more for silver than we are. That's it. Two, why is China buying the silver? Because they're applying it more aggressively in industrial use. So solar silver, they have 80 to 90% of the solar silver chain. So they're basically dominating the market, almost cartelling it, which is why, side note, why I've been saying that I think there's going to be a silver OPEC type of situation. So a SIPEC coming out of this relationship between Latin America and China. Third, we go into China's negotiation style, trade negotiation, how they get these deals, what they do. Fourth, two examples, Trinidad and Tobago is one example of this style, and Argentina is another. Two that we witnessed personally, firsthand, from experience analyzing market structure, and an overview of part two. And in part two, we will post the specifics from that conversation with the mining exec, analyze the direct implications, and comment on longer-term economic effects of the strategy. So basically, that'll be like a reconstruction of the interview.
All-time high. Other than those exceptions, this is the major resistance, and we're coming onto it for a fourth or fifth time, depending on how you count it. And now we are coiling off the 200-week moving average. I do think we are going to break through this resistance finally, not for any lockdown reason or for any spectacular bull top reason like we had in 2011. I just think silver will continue to climb until it catapults in a monetary crisis, which is coming up in the next few months, in my opinion. But let's move to the gold to stocks ratio. We see here that we have a major triangle that has formed since 2000 here. The lower this goes, the higher gold relative to stocks, the lower stocks relative to gold. And we can see here that stocks have been falling relative to gold pretty spectacularly since 2000, 1999, 2000. And we're going to break out of this triangle, I think, lower. And we should head past the low here, which is somewhere between 1 and 0. I don't know exactly where, but we are going back there. This is a longer term chart of this thing over here. This is the same chart going back to 1900. No, not exactly the same. This is the S&P 500 and this is the Dow, but it's basically the same chart. I think I have the S&P in the next slide, so you'll see that too. You can see here, this I call the bikini top of doom for stocks because why not? This looks like a bikini top or glasses, but bikini top just sounds better. I know they're not even, but you know, they never really are perfectly. So we have here, it looks like a triple move where we had lower highs going in the 1960s and 1970s of the Dow relative to gold. And then we had a major top here in 2000 that we've never even gotten close to. And now we have like an echo bubble of the same sort of pattern of lower highs. One here, one here, one here, and it's continuing to fall. So I do expect that we will get to the 1980 lows here which are reflected in 1931 lows over here, slightly lower than that. But this ratio is headed down. I think this top here is not going to be repeated. It means that stocks are going to fall hard relative to gold and harder relative to silver, though silver will catch up at the end, as it always does. This is the S&P 500 relative to gold. Sorry. So the lower this goes, the lower the S&P 500 goes relative.
Everyone, tonight we delve into some pressing developments in the financial markets that could signal major shifts in the months ahead. Financial analyst Rafi warns that a significant financial crisis is on the horizon, potentially unfolding before the year ends. Farber suggests that this looming crisis will trigger another round of aggressive money printing by central banks, leading to a stagnation in stock markets and a surge in the prices of gold and silver, reminiscent of the economic turbulence of the 1970s. Let's start by examining the critical signals pointing to this crisis. Farber highlights a substantial triangle formation in the gold-to-stocks ratio that has been developing over the past few decades. He notes that stocks have been losing ground relative to gold since the year 2000, and this trend is likely to accelerate as we approach the year-end. According to Farber, the charts indicate that the stock market may face severe declines, while gold is poised for a breakout, potentially mirroring the dramatic price increases seen in the 1970s. He intriguingly refers to this as the bikini of doom, a visual metaphor that underscores the gravity of the situation for stock markets. In addition to the gold market, Farber discusses silver, emphasizing that the metal is also on the brink of a significant rally. He cites a Bank of America report that points to a growing deficit in global silver inventories, which have been declining steadily over the past 5 years. This decline is attributed to increased demand, particularly from China.
Chris Marcus from Arcadia and myself, we sat down with, we had a conversation with a Latin American mining executive. And the purpose of the conversation was to learn a little bit more about the concentrate and doré bar side of precious metals, specifically the silver aspect of it. And what we came away from that conversation with was more than we had hoped, specifically confirmation of information that I had coming from the China side of the supply chain. There were claims made by these people in China that they were doing buying concentrate in Latin America. And that was confirmed. And on top of it, the prices that were being offered for the concentrate were off the scale, historically speaking. And we had a nice conversation with the executive on that topic, and I'm putting that out in a two-part post. Part one, which is what we're going to talk about today, is the bottom line. China is effectively laying claim to Latin American silver before it is refined and crowding out Western buyers by paying higher prices for ore.
Is creating ripples that investors can't afford to ignore. Supply and demand dynamics are at play as China outbids Western countries, paying a premium for silver. This surge is driven by China's extensive industrial use, particularly in solar panel production, where it holds a commanding 80-90% market share. Market analysts are drawing parallels to an emerging silver OPEC, predicting that China's strategic dominance may lead to a cartel-like control over silver supplies. The relationship between Latin America and China is pivotal, with China purchasing silver concentrate at historically high prices, effectively securing raw materials before refinement and sidelining Western buyers. China's control over silver supplies is anticipated to have far-reaching economic consequences. According to global data, China is set to become the world's second-largest silver producer in 2023, despite a recent decline in output. Over the next few years, production is expected to rise, indicating a long-term strategy in play. Shifting our focus to supply chain dynamics, traditional vault metrics are becoming obsolete. The key now is understanding where silver is sourced and its final destination. The flow of silver from Latin America to China is a critical trend, with Chinese customs data showing a substantial increase in silver imports, both in ingots and concentrate.
Last week,
It's crap. First of all, my entire career, I've been doing this for 34 years. And I can remember back in the day, everyone said China lies about the amount of gold that they have or produce because their numbers stayed somewhere near 1,200 tons forever. They never updated it. And they've been producing between 300 and 500 metric tons a year forever alone. But they're the largest producers. They're the largest importers. And I said it's a bunch of nonsense. If the commercial banks that work by proxy for the PBOC are buying gold from the refiners in South Africa and Switzerland, I don't think they're telling the IMF how much they bought. If on behalf of the PBOC, if they are buying gold that's not 995 pure or 995 pure or less, they're not telling the IMF how much they're buying. You had the head of the IMF come out and say that their numbers are fugazi, that they're not right, that they are understating it. You had the lead analyst for the Bank of Montreal say the same exact thing. And then there was just a report that came out that said because the bullion banks take care of the gold transport for the PBOC, shipments from London to Beijing are disclosed in UK customs data. And the customs data reveals that the PBOC continued to buy gold in May. Yeah, it was gaslighting to drive the price down 100%. And I think, indeed, if you think about it, why the hell would they be open and forthright? If indeed we are moving to a system that will have gold behind it, like the unit, why would they ever want to tell anyone how much they own? And look at the way that we in the United States do not disclose how much gold we have. Supposedly we have 8,300 metric tons, yet it hasn't been audited since 53. And when Ron Paul asked to audit our own gold, it gets turned down. So, I think it's a situation where they have every vested interest, shall we say, in not being forthright about it. And I think it's a bunch of nonsense that the Western media runs with this because after 18 months of recording purchases, go back and look at what happened way back when. They never updated their numbers. And so this is a deal, as you mentioned, of complete and total gaslighting. And look what it did to the price. And that's the idiocy of the Western investor who does things reactionary instead of being proactive, seeing things for what they are, understanding that in the end, the numbers will play out. Being so reactionary means you'll never win in investing because by the time you are reacting, the big money has already positioned themselves. And so this is why so few people ever succeed in investing because they are reactionary instead of trusting the numbers and understanding that this is all noise. You just have to look at the end game. And the end game is the dollar's in big trouble. We are heading for a very bumpy road. And you can see it by the fact that the most well-funded, but more importantly, well-informed traders in the world, the central banks who are being told probably by the BIS what is coming, have been buying gold at a rate that no one has ever seen before. And you know how they're doing it? The reason that all of this is our own stupidity in the UK and the United States, because we suppress the hell out of the price of gold and silver on the LBMA and on the COMEX that allows these large institutions to run cover, to under the cover of suppression to stand for delivery. And that's the difference is that, most of my career, no one stood for delivery. Now they are. That's how they beat us at the game. And you can see it by the amount of deliveries coming off the LBMA, coming off the COMEX. You can see it if you just pay attention, but you got to dig. And the Western media is doing such a disservice to the public by not telling them what's happening because you can't get out of the way of what you don't see coming. And I would say to you, something like this could go from a little trickle to bang, just like that. Yeah. If indeed they do announce,
Welcome to has far-reaching implications for the future of international trade and currency markets. Over the past few months, China has been quietly but steadily increasing its gold reserves, signaling a profound shift in its economic strategy. In August, the People's Bank of China added another 29 tons of gold to its reserves, bringing the total for this year alone to an astonishing 155 tons. This move underscores China's intent to distance itself from traditional foreign exchange assets like U.S. Treasury bonds, and instead fortify its holdings in gold. This strategic pivot by China is part of a broader, calculated effort to hedge against potential vulnerabilities tied to the U.S. dollar. Despite Western media reports suggesting that China had ceased its gold purchases, it has become increasingly clear that these reports were misleading. China's central bank through its commercial proxies, has continued to buy gold from global markets, often without full disclosure, leading to a significant underestimation of its true gold holdings. What's particularly noteworthy here is the manipulation of market sentiment through these misleading reports. By spreading the notion that China had stopped buying gold, the price of gold was temporarily suppressed, allowing China and potentially other nations to acquire more gold at lower prices. This move has left many Western investors reacting impulsively to short-term news, a behavior that often plays into the hands of more strategic, long-term planners like those in Beijing.
View I did over that time period, I said it's
To gold, and you can see a very similar chart here of lower highs and head and shoulders, and this is also a bikini of doom. And now, I said in the introduction that I would explain why I think that the end of the year is still ripe for the final financial crisis, which will result in the final printing round, which will be bigger than 2020, which was bigger than 2008, which is bigger than 2001, etc. So here we have a chart from a friend of mine, a subscriber to the Endgame Investor on Substack, Dr. John Gideon Hartnett, who Chris has also spoken to. He's a physicist and a very wise man. It says here, I titled it, even if QT stops completely, that takes us to February 2025. I'll explain this chart in a second here. So this curve here is a double exponential. What Dr. John Gideon Hartnett did was he plotted Fed liabilities going all the way back to 1913. This is one section of that graph, and found that the liabilities had to plot a double exponential curve. This is number 2 here, as you see. And every time that the Fed falls below the curve a certain amount, you have a financial crisis. And we find that point to be, in 2019 during the apocalypse, 36% below the double exponential curve. And the Fed went back above the double exponential curve during the 2020 printing round. And when it went below it again, there was a minor regional banking crisis. And now we're headed towards the 36% below crisis line over here. And had QT, this was the line of the trajectory of QT from the time post-regional banking bailout until now. If it had continued on the line that it did, you can see QT slows down slightly over here. Had it continued at the rate it had gone post-regional banking bailout, then we would have hit the 36% below crisis line at August 31st, 2024. And now we're slightly below that rate, so it's going to stretch out. And what I did was I added the calculation that even assuming QT completely stops, meaning the amount of liabilities stays the same on the Fed's balance sheet, or the assets liabilities, same thing, we will only be able to stretch out to about January, February 2025 until we hit the next crisis. Why? Because the double exponential continues to move higher and higher, and the Fed's liabilities must match that. And if they stay stable, we only have a few months left until the next crisis anyway, even if QT completely stops. So this is
where silver consumption is surging due to the booming solar energy sector. Farber explains that as silver inventories dwindle, the market deficit is starting to make a noticeable impact, with further shortages expected in the coming years. This situation is likely to drive silver prices higher as supply struggles to keep up with demand, particularly as governments around the world push for more green energy initiatives by 2030. Now, let's consider the broader economic implications. Farber draws a comparison to the 1970s, a period marked by high inflation and stagnant economic growth, known as stagflation. He argues that while the stock market may not experience a catastrophic crash like in the 1930s, it could see prolonged stagnation, with stocks fluctuating within a narrow range, but losing significant value relative to gold. He also points out that in the 1970s, while the nominal value of stocks didn't collapse, their value relative to gold plummeted by 94%. Farber warns that we could see a similar scenario unfold, with stocks ultimately being worth much less in real terms, even if their nominal prices remain relatively stable. Looking ahead, Farber's analysis suggests that the Federal Reserve's current policy trajectory could lead to another financial crisis by early 2025. He references research by Dr. John Gideon Hartnett, who plotted the Federal Reserve's liabilities against a double exponential curve going back to 1930.
Without directly affecting spot price, right? So coincidentally, today, Bai Xiaojun posted that the market data on SGE and SFE were out, but he also noted that CN Customs, China's customs data in June, 110 tons of silver ingots, which is silver bars, and 100 and whatever tons of silver concentrate, which is equal to about 1,400 tons of refined silver, were imported. That's a big increase to May. Now, the key word is silver concentrate there. And Chris and I recently, here's basically what I just said, right? Discussing silver supply chain dynamics from a miner's perspective. During that conversation, unexpected important corroboration was given regarding China's actions in Latin America. The final result is, okay, well, it's almost like I read that verbatim, but I swear I didn't. And there's a nice little picture of the China silver muncher. Backtracking for a second, here's the homepage. There's that story that I just discussed, right? There's the HeartNet walkthrough, and there's Trump's Bitcoin. So there's, as usual, there's plenty up there. All right, so back to our conversation. So these are the parts of that part one. I'm gonna give you a quick breakdown of it. The bottom line is
negotiation tactics in regions like Trinidad and Tobago and Argentina exemplify its strategic approach to resource acquisition. These moves are crowding out Western buyers and setting new benchmarks for silver concentrate prices. In the gold market, recent activity suggests a bullish trend. Despite a weak performance over the past 6 days, Friday's trading was encouraging, with gold prices climbing in anticipation of potential interest rate cuts by the Federal Reserve. Investors are eyeing the upcoming FOMC rate decision closely. The market is almost unanimously expecting a rate cut in September, which could provide a significant boost to gold prices. This anticipation is generating cautious optimism among traders, with key U.S. macroeconomic data, including the non-farm payrolls report, poised to influence gold's direction. The Fed is expected to keep rates unchanged on Wednesday, but all eyes will be on the September rate cut announcement during the conference.
What's happening in the streets of the UK? I mean, things are upside down, and things need to change, and things are going to change. And I don't know if it'll be peacefully by revaluing the price of gold globally or not, or of a complete and total reset. You know, you look at the lead economic advisor to the U.S. government, this knucklehead named Jared Bernstein. He advocates for losing the reserve status. It's a privilege we can't afford. You look at the number two, Lael Brainerd, and if God forbid, you know, this current administration walks into the White House again, she'll be the head of the Fed. She's a modern monetary theorist. She worked at the Fed underneath Powell. She developed the CBDC with MIT, the Boston Fed. She ran Point for Fed Now, which came out 8 months ago, which is a instant settlement system backed by the Fed, like Venmo or Zelle. And, you know, who knows? She would like to see a reset. She would like to issue a CBDC. Maybe they can do it peacefully. I don't know. But to your point about the West not settling anymore, I mean, look at the $4 premium in silver to the LBMA and the COMEX price that we've seen forever on the Shanghai Exchange, which over the last 100 days, the volume has increased nearly 200%. And the combined volume of the Shanghai Metals and Futures Exchange now supersedes the COMEX, making it the number 2 most transacted platform on the planet behind the LBMA. We're beginning to see that these exchanges are getting more and more legitimate. And at some point, the Western system will be viewed for what it is, a Ponzi scheme. You can only manipulate a market or push a market in the direction that it is going for an extended period of time by pushing in the direction it's going. You can't hold back global demand, and especially global demand that is being orchestrated by the central banks, not in concert perhaps with the Fed. So times are different. You know, most of my career, Andrew, no one stood for delivery. But these countries now, which back when I started doing this, were many of them third world, are now sophisticated, coordinated, wealthy, and motivated. And they understand they don't need to drop bombs in the United States or in the UK to win. They just need to stand for delivery and buy all of the world's commodities. I saw a report that came out of the UK where the UK said, hey, listen, we're kind of screwed. All of our natural resources, we're reliant on other countries like the BRICS nations. And that's true. And if you look at what's happening right now in the United States, we're selling our treasuries largely to the UK. One broke nation selling their debt to another broke nation, taking the proceeds that we sell our treasuries to you folks for to pay the interest on the debt that's already outstanding and take what little is left extra to buy commodities across the globe from the BRICS nations, who take those dollars and buy gold, which keeps going higher, and gold, which will be the backing of a new system. So they're not buying treasuries, they're not stockpiling dollars. This little by little by little by little, then all at once, it's going to happen. It's logarithmic decay. I don't know what triggers it, but I think it's never been more clear to me that this is a path we are heading on. And is it peaceful through gold revaluation and dollar devaluation, or is it chaotic with an all-out dumping globally?
The trend is not isolated to China. Other nations, particularly those within the BRICS bloc, Brazil, Russia, India, China, and South Africa, are also bolstering their gold reserves. Recently, 4 additional countries from the Middle East and North Africa, Egypt, Iran, Saudi Arabia, and the United Arab Emirates, joined BRICS, further signaling a shift away from the influence of Western economies, especially the United States and Europe. As we look to the future, 2 possible scenarios emerge. One is a gradual, controlled transition where gold is revalued, and the US dollar sees a managed depreciation. The other, more alarming scenario involves a coordinated global effort to offload US dollars and treasury bonds, potentially leading to a financial upheaval characterized by soaring interest rates and hyperinflation. These developments point to a growing consensus among some of the world's largest economies.
Where the hell are we? What's happened to this great country? I see